Alright, so I don't want to waste any of your precious time, but just so you know, anywhere on the screen there will be a code for 8k profit from passing challenges. It's a giveaway that I'm doing for you guys as I'm partnering with them. Anywhere in the video there will be this code popping off, and if you're going to be the first one, then you can simply submit the entire code and get a free challenge. Now, first of all, we need to understand external relative equal highs and also internal relative equal highs, because they play a major difference on how to actually spot great quality setups. Now, for the ones that don't know what are relative equal highs or lows to begin with, that is why the X is standing here. Now, for relative equal highs, it's when you have basically two swing highs being relatively equal close to each other. Now, the condition for that is that the second swing high, so this is the first one, this is the second one, is not higher than the first one. If, let's just say, this entire swing high has violated this entire high, then these are not relative equal highs anymore. Even if it's just by 1 point or 0.1 pips, that is still not a relative equal high anymore. Now, in the case where you're already familiar with something similar, it's that there's external liquidity. So basically these are the external relative equal highs. And we also have internal liquidity, which in this case are the internal relative equal highs. Now, firstly, why does this matter? It's because essentially when you're going for a profit target, so basically when you're wanting to take a position onto the upside and trade all the way to the external relative equal highs, that will play a major difference if you're actually going to shoot for those or just for the internal relative equal highs. Because a lot of the times the price will actually go to your internal relative equal highs, does a little bit of stuff in here, and then has a pullback. Now, that pullback most of the times will not have much of a difference, because eventually we will still get into the external relative equal highs. But we want to be out of the trade the same day that we got into it. And we can really only do that by just basically looking out for high quality trades that are most likely just going to last a couple of hours. So now that we actually understand what relative equal highs and lows means to begin with, we have to also understand common mistakes, because I see a lot of people are just trading relative equal highs or lows, but they're making these common mistakes, which just leads to a lot of unnecessary losses. Now, before I'm going to tell you the mistake, just look at this entire price action. If you need a little bit more time, you can pause the video and look for it. Now, where can you find relative equal highs onto this chart? Once again, pause the video because I'm going to explain it now. So firstly, you have relative equal highs in here. These are the very first relative equal highs and probably also the most obvious ones. You see a swing high in here, another swing high, and also another one. Because quickly mentioning, even if you have multiple swing highs that are relatively equal close to each other, they all contribute to that one major, so basically the original relative equal high. This is basically the original high where all of the following ones are just going to be created. Now, a very common mistake now is that people are just going to mark it, well, but these are also relative equal highs. And keep in mind, you are not even wrong on that. These are also relative equal highs. But then you might also be saying, well, we can also take it from this high because there's another swing high in here, and now these are also relative equal highs. Once again, you are not wrong on that. These are in fact relative equal highs by definition, but I'm going to show you why it actually matters more than just identifying swing highs and swing lows. Now, last example, these are also relative equal highs. We have a swing high in here, perhaps another one here, although this doesn't count anymore because it has been taken off by these highs. But now there are more relative equal highs created. Now, this chart gets very messy very quickly, and it has actually reasons on how to avoid this. And the first one is that this is just simply a mistake, as I've told you previously. Now, I've told you that all of these are in fact relative equal highs that you can see on the chart, but they don't really matter because you have to measure the original swing high. So basically this is the very first swing high that has created relative equal highs for us. So if you're going to measure the original swing high all the way to the lowest point, then this is not relatively equal close to each other anymore. You see the difference between this swing high and also this swing high? These are not relatively equal close to each other. Now you might be saying that, well, but these are going to be the external relative equal highs and these are going to be the internal relative equal highs. In that case, you're quite also wrong on that one. The external relative equal highs were here right from the start. These are the actual relative equal highs that are external and not the ones that you're seeing on here. Why? Because it's the highest point out of every of those, because this is an entire price action leg that's going on to the downside. So keep that in mind. Now, but there's one more mistake that most traders are just doing when trading relative equal highs. Now, once again, keep in mind, this is the fundamental on how to trade this entire strategy. I rely on relative equal highs and lows the most when doing trading decisions. They're not the only one, which you will also get in this backtesting session, but just keep that in mind. It's a golden fundamental key concept. A lot of you guys have asked me that when you have relative equal highs, for example, right, but you also have relative equal lows, and you're kind of just in the middle of the chart. So how do I know, or you as a trader, if we're going to go for the high or if we're just going to continue for the low in that sense? And this is basically where discretion and also context comes into play. Now I could name you more advanced reasons on why this is probably going to go for the upside and not for the downside. But you actually need it in a mechanical way, and especially at the beginning, I want you to give you something that you can look out for, which makes it just easier for you to trade. Now in the case where you have basically relative equal highs, but also relative equal lows, you want to basically look out for which one of those is going to be taken out first. Now in this case, the highs, let's just say, are going to be taken out first. Then you can start looking for the relative equal lows. But that also doesn't mean that you're just going to take a short position all the way lower in here, because that is going to result in another loss. Simply because if you're already trading onto the upside, you don't really know when that established movement, so basically all of this in here, is going to stop. So in these cases, what you would rather want to do, if we have already traded into here, you want to look out for established movement onto the downside. Now this can happen at any given moment. This can also take a little bit of time. It's not going to happen immediately. And then from here on, once you're already close onto it, now these relative equal lows, so basically the original relative equal lows, play a major role. Now for the students that are watching this YouTube video, just ask me in the mentorship why it is actually more likely that we're going to go for the high and not for the low, because there's actually a fundamental reason on why that is the case. Alright, so here we are at the backtest. Now if you have just skipped onto this part of the video, then congrats, you have missed out on actual information. But without further ado, let's actually watch the charts. Now what can we spot? On the daily chart alone, we can see that we have clear movement onto the upside. But you have to see every single movement that is going onto the chart, just like a band. If you're going to twist it a lot, then it's also going to twist back a lot. If you're just going to twist it a little bit, then it's also just going to twist a little bit back. I need more confirmation, but that still doesn't mean that we just can't trade onto the upside. We already had our established movement onto the downside. But more importantly, this entire established movement onto the downside, where has it fallen back into? This plays a major role. It has actually fallen back into this FEG onto the daily chart. So now this is telling us that essentially our position is going to be protected if we're going to trade onto the upside. But what else can we spot? Now out of experience, I already know that these are going to be relative equal highs if we're just going to drop down onto the 4-hour time frame. So these are now confirmed relative equal highs, because now we can actually spot them onto the 4-hour time frame. Now what else can we see? There is even more relative equal highs, and yes, they do count as relative equal highs. Now if you would say that, okay, what about these swing highs? Do they still contribute into those relative equal highs? No, because it's a little bit too far away in that case. So essentially, what are these relative equal highs? There are external relative equal highs, and these are what? These are going to be our internal relative equal highs. So now we already have built an entire framework. We're not just trading blindly, but we have a clear direction which we want to trade into. What else can we spot on the 4-hour chart? Now this entire price action has fallen back into it. I'm not going to repeat myself too often here, but this is essentially what has happened in here. Ideally, what we would have liked to see in this entire price action that you can see right in here, you'll be liking that this candle has taken out this swing low, because then this would be a liquidity rate and then you can trade higher. This has not happened, and it's also no problem. But we don't only have this FEG on the 4-hour chart, but also this one. This is not just, mark out every single FEG that you see on the chart, right? Because for example, this one doesn't matter at all anymore. It is that the order flow is currently onto the upside. We're using the FEGs as support. We have used it one time, and probably we're also going to use it a second time. Simple as that. So now I'm going to drop down onto the 1-hour time frame and essentially look out for the same things, if not even more reasons on why to actually not take the trade, depending on the price action, right? So in this case, pretty much the same. We even have more relative equal highs on the 1-hour chart alone. Again, 2 swing highs being relatively equal close to each other. To anybody that is watching on the phone, as you can see, this swing high has not taken out the previous one, so these are relative equal highs. So from here, without further ado, actually, we're just going to take a trade. Now, I've told you previously, you can aim for the internal relative equal highs, but as you can see from the pip movement, this is quite a lot. We don't even want to go for all of this pip movement to begin with, because EURCHF, so the pair that I'm trading right now, is not trading that many pips in an entire day. So basically the ATR, if you're familiar with that. Usually we would like to go for a 10 pip stop loss, but we're just going to base it off of this candle high, and this will be quite alright. Now this is going to be the previous day low, and let's see if this is going to equal to 50 pips. No, it's not. This is 74, way too much for us to actually put our stop loss in there. Now the next logical level that I can pretty much spot on the 1 hour chart alone is only this little FEG that you can see in here, and we're just going to put it right below that one, as this is the last form of protection point that is going to protect it. Now you can also just go for a 50 pip stop loss. It won't make that much of a difference, besides that you will actually get quite a bit more profit doing it this way. So guys, with this strategy you always want to risk 3%. You're not going to lose 5 times in a row with a 95% win rate, so always just go ahead and risk that 3% on every single trade. So from here, we simply want to let it play out and see how this is going to go. Now for some reason this is going pretty slow, so I'm going to speed it up a little on the 4 hour time frame, and let's see what is going to happen. And that's a straight up take profit hit. Now of course the chart can continue higher, but everything that happens after our take profit or stop loss, doesn't have to be take profit, has been hit, we don't really care about it anymore. So I am going to remove a couple of things, and we have to basically go to the whole next day for that entire session. So now we are at 0 AM basically, because the next candle is going to open right in here. Now what can we spot onto the chart? We have even more liquidity created, right? We don't even have to basically rebuild the entire framework. If you have already identified the framework, then you basically just have to stick to it. Now remember what I've told you previously on, let's just say, the 4 hour time frame, right? I told you that ideally this low has been taken out by this low. Has never happened. What can you spot in here? We have fallen back into the FEG, then this entire low has been taken out. So now this is even more reason why price should actually continue higher, because now it has actually taken out fuel. In this case it has not taken out fuel, still went higher, no problem. But in here, this is pure confirmation that the price is just screaming to go to the upside. Not to mention that all of these candles, it just established movement. But let's look further into the candles to further understand the logic that I'm trying to explain to you here. Do you see these two candles? Once we have taken out liquidity, the candles have a very big wick onto the downside. So this essentially means that at one point in time, this entire candle was looking like, okay, we're just going to go to the bottom of the ocean with this entire candle. But it has reversed. The next one as well, it has reversed. So this is telling us that buyers are getting into control now. Sellers are not strong enough to push the price lower and lower. Especially because remember, this entire low is also protected by this entire FEG, because it's a protective low now. So once again, we're going to drop down onto the 1 hour time frame and essentially just do the same that we have done previously. We really only want to trade into the relative equal highs. Now in the case where you might be saying, well, but the previous day high has already been taken out. Usually that is an absolute no-go to trade, but these are the exceptions of the entire strategy. It only comes with experience or me telling you exactly what are these exceptions are, such as in this case. We have an entire framework built that the price will go higher. There is no reason for the price to just continue lower and lower. So we are just going to take that trade, even though the previous day high has already been taken out. Now in this case, we can also even do a little bit of entry refinement. The reason for that is because this already is established movement. If you have these two candles going lower, what are the chances that we might as well just take out this low, for example? They are pretty high, so we're going to basically put our entire entry right at this low. So from here on, we want to take the trade. Now in the case where the take profit has been hit before we're going to enter the trade, then we have to cancel the entire order. So as always, we're going to risk 3%, and for some reason FX Replay is just very unprofessional platform to trade on. Now quickly guys, over the years I've most likely tried every single journal that is out there, but none of them has actually come close to what TradeLens is going to give you. TradeLens has an integrated AI assistant which is going to help you further analyze and understand your trading behavior. I'm using it myself, and if you want a 10% discount on every single purchase, the link to that is in the description down below. Alright, so there we go. So in here, let's see if we're going to get into the trade or not. Yes, we got to enter into the trade, and then from here you want to see how this entire price action is going to fold. Now we are trading back into this FEG, quite unexpected because we have already traded back into, but from here on that's a straight take profit. Now of course I cannot expect or explain to you exactly why we have traded lower first. There could be tens of different reasons, and even those tens of different reasons are not always going to work. So keep that in mind when trading the strategy. Don't try to be perfect, just try to make money. I'm going to repeat myself here. The only thing that I want you to do is making money. Don't try to be perfect. So in here, that's another win for us, and we're going to quickly just remove a couple of different things. Now we're going to skip onto the next daily open and see how this is going to get. Now we have traded massively lower, have taken out the internal relative equal highs. And this is exactly what I've told you in the very beginning of the video. Remember, guys? So when you have relative equal highs for the internal and also for the external, you always just want to aim for the internal relative equal highs. Now, of course, if we had even more movement to the upside, and let's just say that we're going to continue starting trading in here at the 0 AM candle UTC standard time, then yes, we might as well just go for the external relative equal highs. Since that has never happened, because we have already taken an entire trade on this day, and we have to skip onto the next one, this has not happened. So just by identifying the internal and external relative equal highs and not aiming for the external ones, you are making your job as a trader, or basically trading the strategy, a hell lot easier. So in this case, what can we spot? I've skipped onto the 0 AM candle. Once again, the next one is going to be the 0 AM candle. Have we traded into the previous day low or not? Now, keep in mind that this is 100% establishment onto the downside. Without a doubt. You cannot say that, well, but there's only one candle. It doesn't even have to be a series of candles. It can really just only be one. What else can we spot? We do have relative equal lows onto the 4-hour time frame. I mean the daily right now. So essentially we probably will continue lower. Now a question to you. Are those relative equal lows external or internal? And if they are not the external relative equal highs, and if these are not the external relative equal lows, then where are the actual external relative equal lows for that sense? Now, as always, pause the video if you need a little bit more time, but in that case, simple as that, is these ones. These are the external relative equal highs. Why? Because this is the last major point where there are relative equal lows to begin with. It's not those. Why? Because these ones are not relatively equal close to each other. You see the difference? But those are quite close. And this is basically the last price action leg that has actual relative equal lows attached to them. So these are going to be our external relative equal lows, and these are going to be our internal relative equal lows. So now that we have that in mind, what do we want to target? The internal or the external? We've already seen it previously. We want to target the internal relative equal lows. So we're going to drop down onto the 4-hour time frame, look out for more information. Now what I can already see and tell you right from the spot is that this FEG is not going to stay like that. We will trade into it because massive FEGs like that tend to never actually stay in the chart. In previous videos and also just lectures, I've told you that we like to trade into the FEGs, and rarely ever do FEGs not get traded back into. Yes, that is the case, but sometimes there are also FEGs that are not getting traded into. But when you're having a big FEG like this, so this is essentially also on the 4-hour time frame. This is not just any time frame on the 1 minute or something like that. This is an actual imbalanced price where the market was not efficient enough to fill out every order. So in that case, this FEG will be taken out without a doubt. I can already guarantee it to you. Out of experience, it will happen. So, which also means that we basically have an entire framework already, because we have the previous day low, which we want to trade into, the internal relative equal lows. But once again, we also have the 4-hour FEG. So you might be saying, well, the 4-hour FEG is quite concerning and it's hurting our entire position. Well, not quite, because this entire movement is still going onto the downside. So we don't even have to put our entry in there, because I am pretty sure that we're going to go for the internal relative equal lows before we're going to go back into the FEG. Which also means that once again, you're not going to target anything lower than that, because it's not worth it. We will trade higher once again. However, there is one problem. This is more than 20 pips, which we don't like to trade into. We ideally want to go for a 10 pips take profit, and that's about it. Now we're going to drop down to the 1-hour time frame and see if there's any logical level. Now in this case, there's not really any logical level that you could put your stop loss in. There's only this FEG, but if you're going to put it right above the FEG, then it's just too little of a stop loss. So we're going to keep it at 50 pips in that case. So in here, market order, 3% risk, and as always, just let it run. Even if we're going higher or not, just let it run, guys. Okay, so we have actually traded into the internal relative equal lows. In these cases, a lot of you would be saying, well, we have traded lower. But guys, once again, this worked this time, but it might not work the next time. So keep in mind. Now, although I am casually on 20+ winning streaks, I still try to avoid every single loss possible. A loss is inevitable, it will happen eventually, but you have to understand, to not trade the bad trading days or the bad trading setups is more important than catching a good one. So with this entire day, we're just going to skip on to the next day and see what we're going to get. Now I have removed the entire internal relative lows as we don't need them anymore. Now what else are we left with? We're basically still left with this massive FVG, which we have not been traded back into yet. And also on the daily time frame, what can we spot? Massive wick onto the downside. Now just asking you a very simple question here. Is this the kind of day that you would like to participate in or not? The reason for that is you can already see that buyers are getting into control because of this entire wick. This is a lot of different pit movement that sellers were not able to basically push the price lower. Now granted, everybody who sold there was able to basically push it lower by another 70 pips based off this entire body, but this is still not enough for us to actually build a trade from because we were not able to keep that level. That's the major difference. Granted, you could also say that you have relative lows in here, but they don't matter given the specific context. So we're going to skip this entire day and not trade it. So we're going to skip it, and it's a very classic example. So although it is looking bearish and we're just going to go to the downside, this has not happened. And a lot of the times when you're going to avoid these kinds of traps, you're actually going to get rewarded by the market, such as in this case, because this already is now a very good setup. I can already see it right from afar. So if you are going to pull out your entire Fibonacci level and basically base it off from the last swing point and also to the last swing low, basically, you're going to get the premium and the discount range. So this entire 4-hour FVG is mostly in a premium range, but we don't even care about that. Firstly, price always likes to go, so similar to the FVGs, right? Price always likes to go to the equilibrium of this entire price action move. So most likely we will also trade back into that point, but we don't even want to trade all the way to the equilibrium. This is just additional information and confirmation in that sense that we want to trade higher, but we don't even want to trade in there. Once again, what we actually want to do is basically remove a couple of different things, and we have this entire FVG. I've told you previously, we like to trade into the FVGs and not away from them. So I'm going to mark it out FVG onto the daily time frame, and these are also going to be relative equal highs. Why? Because if we're going to go on to the 4-hour time frame, you can already see we have a swing high in here, another one in here. Probably we will continue higher, but that's not even all. We are probably going to trade into the 4-hour FVG, but once again, we don't want to basically overextend the entire take profit. We want to keep it very simple, especially because we're already starting to have engineered liquidity. Now, engineered liquidity is basically when the market is going into a certain direction and is also tightening up, but not only that, it's also not taking out liquidity of the opposite direction in order to trade higher. So a classic example is just like in here, when you have a price action like that. So usually for the market to go higher, it needs to take out liquidity first and then it can continue higher. So this is either your pullback or your liquidity grab in that sense. This has not happened here. We're just trading higher and higher. We're not really taking out major liquidity to go higher. So in that case, this is engineered liquidity, which we have to be really careful of. We're going to drop down to the 1-hour time frame, which we already are on. And from here, now guys, if you're having problems passing your prop firm challenges, then I'll pass it for you. In the case where I don't pass, you'll not only get the money back that you have paid me, but you'll also get the money back that you have paid the prop firm in order to get the challenge. As always, everything is in the description down below. We basically want to take a position. Now there is a couple of FVGs which we have not traded into, also on the 1-hour time frame, which is basically additional information. Now in that case, the entire previous day high is not enough for actually us to go for a 10 pip stop loss. But once again, given the circumstances of this entire move right now, this is still okay to trade. Simply because we are having way more potential to trade onto the upside. You are actually able to build a framework by having a lot of momentum or confirmation to one direction. So these are more of the exceptional trades, but usually you always want to target the previous day high and just overextend your take profit by a little bit. So in that case, what do we want to do? We have the relative equal highs. We have a lot of different information onto the chart, and this basically light work for us. 3% risk as always. We're going to market order in, and from here, let's see what happens. We'll definitely got filled into the trade, no doubt. And this is another take profit hit. Now, these trades are also not taking you that long, 9 hours. Now, I know you might be wanting into the trade in a couple of minutes, but guys, this work that I'm doing in here takes 50 minutes a day. But in reality, especially when I'm doing market outlooks for my students, this barely takes 5 minutes for me. So here are the backtesting results. It's a 100% win rate. As usual, this is nothing special to anybody that's trading this strategy, but it is not going to be having a 100% win rate over an entire year of trading. It's not going to happen. You'll also have losses eventually when you're going to take 100 trades or 200 within the entire year. However, as more long-term backtests that I've already previously done have shown that we are achieving close to a 95% win rate. So no matter how you're going to twist it, this strategy is destroying everybody else in the charts. Now quickly, if you're interested to trade with me side by side with me and everybody else that is in my membership, it's in the description down below. And if you still believe that trading a negative risk to reward is not practical in the live markets, then click on this side of the screen, because I promise it is going to convince you. And if you want another backtesting session, so getting more details on how to do this on a day-to-day basis, then click on this side of the screen, because it is going to be another backtesting session for you. If you have not clicked on the video on neither of these videos, then just like the video, subscribe to the channel, and comment down below what your favorite trade of this entire backtesting session was. Thank you guys for watching, see you in the next one.